Part 16, Insurance, Meaning and Principles. Insurance, meaning. Insurance refers to that written contract or agreement between two parties through which the insurer pays premium and as against getting an undertaking from the insurer that he will be compensated as per the risk covered and the amount decided for the financial loss. Insurance means an arrangement by which a company or the state undertake to provide a guarantee of compensation for specialized loss, damage, illness, or death in return for payment of a specified premium. In simple words, a thing providing protection against a possible eventuality. In this insurance, there is two parties: insurer, those who are giving premium, and the insurer providing services. Insurance is a contract in a written form is known as insurance policy. It is a contract between insurer and insurer. It's a written contract is known as insurance policy. Insurance does not remove the risk involved by it compensate for the financial loss caused by that risk, and especially saying that insurance does not remove the risk. Insurance never prevent any damages or any accident. Insurance only will compensate that damage, financial loss caused by that risk. For example, vehicle going to insure for compensation of any risk happen. It will never remove the risk or accident or any damages, but it compensates the cost of risk by taking an insurance policy. Principles of insurance. The rules of insurance are connected with society and it is an agreement between two parties. So insurance is not a simple or ordinary contract and it cannot be related to law of contract. It is a special form of contract and hence apart from law of contract, the following specific principles are applicable. The basic principles of insurance is that an entity will choose to spend small periodic amounts of money against a possibility of huge unexpected loss. Basically, all the policyholder pool their risk together. Any loss that they suffer will be paid out of their premiums which they pay. It is based on the contract between insurer and insurer. It is away from the law of contract. Then insurer will give a premium, a small amount to the insurance company or insurance provider that will help to reduce the cost of damage. It will compensate the cost of damage by insurance. Principle of utmost good faith. The main objective of an insurance contract cannot be of making profit. It is only to have compensation for financial loss. The basic law of insurance is a social concept. As such, the parties involved in the insurance contract should have mutual and complete faith. While entering into a contract, both the parties should provide all information required and regarding the insurance product. While taking an insurance policy, even if the information is not asked by either parties, both should provide it. If it is felt that it can have an impact on the contract. Any insurance agreement entered not having the necessary information amounts to fraud as it is. The main objective of insurance contract to be avoid the damage loss. The main objective of insurance contract cannot be of making profit. It will compensate the loss happen in any accident. It's a basic contract in which both parties want to share their details. The principle of utmost good faith states that the insurer and the insured must disclose all material fact before the policy inception. Fact which may enhance the level of risk are called material facts. The insurer or insurance company needs to declare all public disclosures and investment strategies, while the insured needs to declare health condition, family medical history, lifestyle, food habits, smoking and alcohol history, etc. In case of non-disclosure or misrepresentation of material facts, the policy can be considered null or void. The principles applies to both life insurance and general insurance policies. The principle of utmost good faith is saying to us about both parties, insurer and insurer, want to disclose each and every details about their insurance policy as well as insurance goods or insurance property. Otherwise, insurance company will find out any misleading or misrepresentation of any facts or ideas or information about this insurance policy going to nullify or going to cancel. It will affect the insurer and the insurer, and it will affect the compensation of the risk. And second principle, principle of indemnity. The principle of indemnity is saying that indemnity is a guarantee to restore the insured to the position he or she was in before the uncertain incident that caused a loss for the insured. The insurance company promises to compensate the policyholder for the amount of the loss up to the amount agreed upon in the contract. Insurance contract is made to compensate for the loss incurred by the insuree. So the main objective of insurance is the principle of indemnity. This principle is used to decide how much the insurance company will have to pay to the insuree in the event of loss incurred. Any person who takes an insurance policy can get only compensation for the loss, and he cannot earn profit. In other words, he cannot get additional amount over and above the loss incurred. It is not applicable to life insurance. Principle of indemnity asserts that, saying that on the happening of a loss, the insured shall be put back into the same financial position as he used to occupy immediately before the loss. In other words, the insured shall get neither nor less than the actual amount of loss sustained. It is not applicable to life insurance. We can't compensate a person's absence. If an insurer takes a policy for a product at a lower value than the original value, it is implied that he will proportionately getting lesser amount, and a part of the loss will have to be borne by the insurer. Going to take a policy for a product, he will show its price as lower than its actual price. Then any damage happen to this product, as per that insurance amount, he will get a compensation. Example, if a person takes an insurance policy for a 3 lakhs, but the original value of the product is 5 lakh, then in the event of complete loss of the product, the insurer will get maximum 3 lakh, not 5 lakh. When the value of the product is 5 lakhs, but the insurer has insured it only for 3 lakhs, and if the product is partially damaged, which is estimated at 2 lakh, insurer will get only 1 lakh 20,000 as compensation, as it is the proportionate amount of 3 lakhs, which is the insured amount. When the value of the product is 5 lakh and it is insured for the full amount of 5 lakh, and in the event of complete damage to the product, insurance company will pay the full amount of 5 lakh to the insurer. So if an insurer takes a policy for a product at a lower price, as proportionately compensation he will get. Then 5 lakh product going to insure for 3 lakh, then partially damaged, he or she will get a proportionate amount only. Then when the value of product is 5 lakh and it is going to insure for full amount, then fully damage, he will get that full amount as compensation. Third principle of insurable interest. The insurer must have financial interest in the product insured. Example, the owner of the house has financial interest in a house while a tenant of the house does not have financial interest. It means that principle of insurable interest on life insurance is that a person or organization can obtain an insurance policy on the life of another person if the person or organization obtaining insurance value the life of the insured more than the amount of the policy. In this way, insurance can compensate for the loss. The insurer must have financial interest in the product because of he have some insurer interest just means that subject matter of the contract must provide some financial gain by existing for the insured or the policy holder and would lead to a financial loss if damaged, destroyed, stolen or lost. Saying that actual owner have the interest to protect the product. Principle of subrogation. When a policy is taken for an insurable product and if it is fully damaged and when the insurance company pays compensation, the fully damaged product is ownership will be with the insurance company. This principle is not applicable in case of life insurance. In the simple words, the subrogation principle in insurance means when insurer or insurance company pays full compensation for any insured loss or insured property, the insurance company holds the legal right of the insured property. In simple words, if insurance company given full amount to the insurer and ownership of that product going to transfer to the insurer to insurance company. In this part, we studied about meaning of insurance, principles of insurance, principle of utmost good faith, principle of indemnity, principle of insurable interest, principle of subrogation.